Good afternoon and welcome to the Wentworth Resources PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand over to Catherine Rowe, CEO from Wentworth Resources. Good afternoon.
Thank you very much and good afternoon, everybody. Thank you for taking the time to join today. Delighted to be able to present our full year 2021 results. Great set of results, which we're excited to tell you more about. So thank you again for joining. I will run through my brief overview presentation and then we can address questions from anybody. Moving through to our first slide. Really, just want to cover here the three pillars essentially of our business. Really what's driving our business historically and all of the opportunity for the future is the growing demand that we see for our natural gas in Tanzania. We are a natural gas producer. We're one of only two producing gas fields in Tanzania for power generation, domestic gas to power. Is the Mnazi Bay field is our asset that we are in a partnership with our operator Moral and Prom and also the government body TPDC, who is also the off-taker of our gas. And it's that partnership that we believe has really allowed us to demonstrate such robust and strong returns that we're about to talk about this afternoon. So we see that growing demand in Tanzania. Natural gas is a key part of the energy mix in Tanzania, and we expect a significant growth to come even from existing levels to support the government's goal for universal access by 2030. So every citizen in Tanzania having access to electricity by 2030. We've got some way to go, but that is what we're here to do to support the government with that. Alongside our partners, we're currently generating 50% of the natural gas supply, and that's really looking to grow and grow as the economy develops and looks towards industrialization of its economy. Operational delivery. Operational delivery is really strong for us at Wentworth, and we're seeing that more and more with the results that we're putting out. Production average last year ahead of our guidance, which we also adjusted upwards in the middle of last year. So really strong production of just under 82 million cubic feet per day from the field. And that's from our existing 5 wells in the field. And we're really able to support that increased supply due to some of the workover program we did last year as part of our annual work program and budget, and you can really see tangible evidence of that work program coming through in these incrementally additional volumes. It's a very low cost operation. We're very fortunate that we have a low cost of production. You can see there 54 cents per MCF, and you can see across the gas price that we're now getting this year of 3.44. So you can see that there's a healthy margin which drives the profitability of our business. We also announced in January, as we always do, our annual reserves report, which is an independent verification of our reserves. And you can see their post-tax NPV 10 valuation of our reserves of $108 million. And when you compare that with the current market valuation, it's looking very favorable that the foundations are underpinned with our business. So operational delivery, the quality of the asset, high quality Mnazi Bay asset leads in to the financial strength that we're really able to demonstrate through our numbers. And today we report best ever revenues in our corporate history, strongest set of financials with a 26% increase year on year in our revenue. We remain debt free, very clean balance sheet with now just under $23 million of cash. And that allows us the confidence to continue our progressive dividend policy. That dividend policy is not new. It's been in place since 2019. So we've really established a track record of being able to pay a dividend even throughout the difficult years with COVID in 2020 and a bit last year, maintain that dividend and increase it. And that's a real commitment. It's something we feel very strongly about. And we're now yielding approximately 8%, which is by far the highest in the African-focused E&P listed space in terms of dividend players. So we feel that's a real differentiator and demonstrates the confidence, not just in the asset, but also in Tanzania. Mainly because we are paid regularly on time by TPDC, our main off-taker. We have several years of fantastic track record there. And the contracted price that we just mentioned, really important to stress that it is a fixed price. So we have a lot of visibility throughout the duration of our contract. It's that visibility and transparency that lends itself so well to the capital return. But it also increases with inflation. And when we have a low cost of operation, as we do, that's very healthy to see that inflationary uplift. Just so you're aware, that inflationary calculation is US CPI, and it's done a year in arrears. So we are expecting a higher inflationary impact for our gas price from the 1st of January 2023 to take into account the higher inflation that we're seeing around the world at the moment. So that sets the scene for who we are and our place in Tanzania's goal to increase energy access and really drive access and energy demand in Tanzania. And we, as I say, a lot of opportunity to improve that. So just moving on to this slide, brief overview of the financial strength of our business last year. Really important, absolutely critical in our industry is that health and safety is priority. And we're really proud of our health and safety statistics. Since material production started into the national infrastructure pipeline in 2015, we've had no lost time incidents. We had no disruption due to COVID, and we've taken extra precautions at the field during that time, and are really proud to say that it's been a very safe and well-run and well-operated field. The dividend, we declared our final dividend today, subject to shareholder approval at the AGM. That is $2.7 million. It is an increase from the guidance that we provided when we declared our interim dividend, which at the time is 2.64. So we've been able to increase that final dividend, which is very much in line with that stated progressive policy that we committed to last year. We also initiated a buyback program at the end of last year, and we're continuing with that throughout the course of this year. And that's really to supplement and sit alongside the dividend, the dividend return as well. And we believe that's an accretive way to return capital to shareholders and also take advantage of our share price being considerably below that core value that we talked about earlier of $108 million. We talked about record production in Manazi Bay. We've also had a very strong Q1, but the production the strength of the production we saw last year gave us that confidence to increase our guidance to 75 to 85 million cubic feet per day average for this year. And that's looking fairly comfortable given the strength of the first quarter that we've had, which we announced today, and hope that maintains throughout the year. So fantastic revenues, best revenues we've been able to report. That's really underpinned by that long-term gas sales contract with the fixed gas price and with the healthy, clean balance sheet really allows us to have a very healthy and robust business model. Sustainability is really important to us. It's really important as an international business operating in a country like Tanzania that we take it very seriously, our social impact and also our carbon footprint and our emissions. It's just impossible not to take that seriously in this world in which we live, and particularly in our sector. And we do at Wentworth, and we've published today our second sustainability report, and that's available on the website for more information. So it is our ambition to grow our business through growing production to meet the demand that we see coming to support that growth in Tanzania, both in terms of population growth, but also the industrialization that we see coming and helping to accelerate that socioeconomic growth. And we're a big part of that, big part of that story. We've talked about production. I think the things to really pick on this slide is we are seeing that demand coming through. You can see in the chart here, we really started material production in mid-15 and really picking up from there in 2016. And you can see that it has pretty much increased throughout those years. We are looking to see a higher 2022 and beyond in terms of that demand. And it's now our priority to ensure that we can supply into that demand. We work very closely with Prom. We are non-operator, but we do feel we have a great deal of influence in the partnership. We contribute technically and operationally and at the government relations. So all our stakeholder relations are important to sit alongside the work that Prom also does. So we work very well together, and that's allowed us to really make the most of the field, be able to make the operation as low cost and as efficient as possible. And as I said earlier, really importantly, that it's run safely. Financial strength, the business has gone from strength to strength. Had a very pleased with the results we recorded for the financial year 2020, despite the global pandemic and the macro difficulties and challenges. Again, we've gone from strength to strength for 2021, and really proud of that. And obviously that does allow us to record that increased dividend and declare that. We have talked about our capital returns policy. It's a big commitment for us. It's becoming more and more a focus for companies in our sector to return capital. But as I say, we've been doing this for 2 years now and establishing a track record that actually we can deliver, and the asset and the business is capable of delivering those returns to shareholders year on year, whilst we also look to grow our business. And why we're looking to grow our business in Tanzania, because all of the indicators are there, all of the positive economic indicators that industrial demand is coming through, and that we are going to be able to give everybody low cost, affordable electricity in Tanzania. And that's what this is really about. So we've got a lot to do, a lot of opportunity. And when there's only two producing fields in Tanzania, it's very much our opportunity to grasp. So that will, and just on the dividend, obviously that will mean a total distribution of $4 million for the financial year 2021. This slide really just highlights the direction of travel of our business. For those of you that haven't been as familiar, it's taken us time to build this robust position, but we're very proud that we've been able to do that. We've been able to build cash, pay down our debt. We had a term loan to help us finance the development of the field. We've been able to really drive profitability through the reduction in costs, which you can see in the EBITDAX, and we are looking to increase production volumes as we move forward this year and beyond. The dividend is a real differentiator for a company of our size, and for me, it really is testament to the quality of the asset and the environment in Tanzania that's becoming increasingly business friendly and increasingly rewarding to be a part of. We've paid back nearly $11 million since we started our policy, and as I say, we're one of very few in the London listed market. We're also yielding much higher than the African-focused dividend players as well. And coupled with the buyback, the share buyback that I mentioned earlier, we feel that we are returning a good level of capital to shareholders, whilst also considering how best to grow the business at the same time. Just wanted to spend a few moments just on Tanzania. For those of you less familiar, I think it's really important to see how we fit into the wider picture and how Wentworth fits into that that macro perspective in country, we think that over 50% of power generation is supplied by natural gas, that 57%. And as I say, that comes from 2 fields in Tanzania. So, this is, it's fairly extraordinary that over half of the power generation in country comes from 2 producing fields. Hydropower is an important part of the energy mix in Tanzania. We're very supportive of that. Tanzania takes a very proactive approach to reducing carbon and accelerating access to energy, but in a lower way of carbon as possible. And for some of its neighbouring countries, that's very impressive. So we see hydropower continuing to be an important part of the mix. We support that, but of course, natural gas is there to underpin and support the grid and the base load when the unpredictability of the hydropower doesn't allow for that. So we think that both are required and can sit nicely as we move forward in the energy mix, while seeing a decreasing emphasis and a decreasing need for HFO, the heavy fuel oils, which is reducing more and more as the reliability of gas and hydropower improves. We put this in because I think it's really important to show that Tanzania is really committed to developing itself, and you can see this in really tangible under construction infrastructure projects. These aren't in design, they're not being negotiated, they're not trying to get funding. These are projects that are under construction and will transform the country. And for me and for us, that really shows the commitment to Tanzania to develop. And as we know, you can't develop an economy without low-cost, reliable power. So we have the pipeline from Mtwara, Mnazi Bay, our asset, up to Dar es Salaam. That's the main pipeline into which we produce our gas. But there's much more. There's the additional hydro plants, there's the standard gauge railway, which I'll come back to in a moment because that impacts potential additional demand for gas. You probably have heard about the potential pipeline to Mombasa. It's very much supporting and illustrating Tanzania's commitment to being that East Africa energy hub that it's really trying to be, and it's got all the right ingredients. Importantly for us, the pipeline is very important. Bold move by Tanzania when it began construction in 2013, 2014. Is the largest natural gas infrastructure project in the whole of East Africa. So it was a bold move by Tanzania to take the decision that this country can utilize the discovered onshore gas for power generation and affordable and reliable power generation, which is really the key. So we also need to be mindful that transmission and distribution of being able to evacuate that power is readily available, and that's why you can see additional lines, transmission distribution lines being put in and all the time, particularly around the rural areas in Tanzania, which is where we see the most extreme poverty and energy poverty. So for me, this is really a sign that Tanzania is taking its industrialization and its development of its economy seriously, and we are a fundamental part of that. Some of you may have seen this before. I mean, this is really what we're all about. We are trying to empower the citizens of Tanzania with our low-cost, reliable energy from our natural gas. And these statistics are really compelling. They show how we've moved forward. They show what it's doing, how it's enabling, and how it's doing it in a low-carbon way. And it's only going to improve. We can do more and more, and I'd like to see what this looks like in 3-5 years' time. Just how many of those rural villages are connected, how everybody has access. It's very easy for us to take that for granted when we're used to just low-cost, reliable power whenever we want it. But this is really what's driving our purpose and makes us successful, because we have that real, genuine alignment with the government. I talked about sustainability. Sustainability is right at the heart of how we run our business. And it's not a nice to have. It's critical that we take it seriously. We're fortunate that we have domestic gas for power, so we're already having a good impact, a social impact to the community and the country in which we operate. But we have to do more. We have to always be looking at ways we can improve. Last year, we published our inaugural sustainability report, and we were proud of that, the disclosure that we were able to make through our admissions. And we've built on that this year. So we've included more and more disclosure. It's all available in the report. We set up a sustainability committee to really help with the governance to ensure that we go a little bit deeper on our efforts. And that's been very successful so far. We also took the proactive decision this year to have our emissions independently assured. That's quite a proactive step in our peer group. Again, that's at the back of our report. But it is very much in line with moving towards that TCFD disclosure that will be a regulatory requirement for all companies by 2025. So we're being ahead of the game, we're taking proactive steps, and we believe that's another real differentiator for our business. The other thing we announced last year that we're in the middle of working on are some bespoke community projects to help offset some of our emissions. We're doing this in partnership with Vitol, who are a long-standing supportive shareholder. And it's really important that we tailor make projects for the community in which we operate, so Mnazi Bay, Mtwara region, and projects that will mean something for the people there, rather than just off-the-shelf carbon offset projects. We want to make sure that they're tailored and they're value add, and ultimately they're going to be successful. I think we've all seen examples of these projects not being successful, so we've taken various steps to ensure that this will be as successful as we can possibly make it. So this report has been published today. It is available on our website, and it's very important also for our in-country stakeholders that they see how much our commitment and our dedication to taking sustainability seriously. Really big part of that is our emissions profile. We have a duty as a public company and as a sustainable, long-term, credible partner to take responsibility for our footprint. We have a very low emissions profile, as you can see here, and it is one of the lowest, if not the lowest, in the London listed market. So again, very proud of that. But it doesn't stop there. We are looking at ways to reduce that abatement, obviously, in the first instance, if we can, but partly through these offsetting projects that I just talked about that we're partnering with Vitol. And you can see we are looking to reduce year on year those emissions, as we have this year. So what is the outlook for us? Really strong set of results. Strong increased dividend, great performance for Q1. We were delighted we had our best ever record quarter last year in Q4. We've been able to build on that and have our best record quarter in Q1 this year, and really looking to follow that through the year. What I've tried to do here on the right hand side is, again, some of you will have seen this, but this is the visibility that we see coming through in that increased demand. So why do we feel that's coming through, and where is it coming from? We are seeing some increases from additional industrial customers. They have been traditionally quite small volumes, so we will expect over time that's the real step change in gas demand, as those industrial customers become more and more available in country, but taking, demanding more and more gas. So that's one key thing. Quite more near term, perhaps, in scale, is increasing demand from the Kinyerezi 1 extension. Now, we believe that will add around 185 megawatts of additional capacity into the grid. We know from TANESCO that they are hoping to complete the first phase of Kinyerezi 1 extension of around 70 megawatts in April this month. So if that is the case, we will see an incremental, we should see incremental volumes of around 11, 12 cubic feet per day from that extension. And what gives us the confidence about that Kinyerezi 1 extension is that we can see the existing power plants to which we supply, Kinyerezi 1, Kinyerezi 2, Ubungo 2, Ubungo 3, those are the existing power plants that we supply. They are now operating at near full capacity. So there is now the need for Kinyerezi 1 extension to start being commissioned and taking additional volumes of gas. I mentioned Ubungo 3. We are supplying Ubungo 3. There is a refurbishment program for that power plant and some upgrades which will deliver an additional up to additional 112 megawatts, and that would give us around 9 or 10 million cubic feet per day of incremental volumes. So that is also expected to be underway this year. I mentioned the standard gauge railway on the infrastructure map. That is almost complete and looking to commission the first phase, which will require, we think, around 70 megawatts. So that's another thing that we're keeping a close eye on. And in terms of new industrial customers, for example, Gator Gold Mine is now taking purchasing power from Tanesco for the first time. So you can see tangible evidence of that increased demand coming through, and you can see it in our reported figures. So we are reiterating our annual guidance today for the year of 75 to 85 million cubic feet, but obviously feeling fairly comfortable with that given the strength of the performance, albeit we're still early in the year. So summary really is great opportunity for us to do more of what we're good at. There's real visibility and excitement around the development of Tanzania, certainly helped by the leadership change last year. Our new president has nearly been in office for a year, and she's made great strides in promoting the country, ensuring international investment is seen to be welcome. You've seen the offshore operators, Equinor and Shell, re-engaging on the discussions around the LNG project for that offshore discovered gas. So there's lots of positive momentum, and I think we can just continue to do more and more and build our business, whilst also being able to continue delivering on our capital returns. So that's my summary. I'm very happy to address some of the questions now, but thank you very much for listening.
That's perfect. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated just on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Catherine, as you can see, we received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. If possible, please could I ask that you read out the question and give a response where it is appropriate to do so, and I'll pick up from you at the end.
Great, thank you. Okay, well, I'll tackle a pre-submitted question first. Would appreciate why we're holding such significant cash on the balance sheet. There's no expansion plans to utilise the cash, and could this be distributed to the shareholders as dividend? So I think that the real answer here is that we are going to look to reinvest back into the field. It's a fantastic asset. It's got longevity far beyond our current license term of 2031, in our view. And we want to produce more and more. We believe there's further prospectivity in our concession, all of which is ring-fenced with our cost recoverable PSA, our production sharing agreement. So all of our costs are recoverable. If we do spend additional money drilling, that's all recoverable over time. So we do believe that there will be additional investment back into the field, and that will be an additional development well. It will likely include some exploration drilling. It will include a compression project, which we plan to do next year. And absolutely, it's the right thing to do to extend the life of the asset, but to get more out of this asset. There's plenty more opportunity. So we do need to reserve some of our cash and some of our balance sheet strength to be able to fund our share of that investment. But we go through a capital allocation policy to ensure that we're still returning a good level of dividend to shareholders whilst retaining financial flexibility, whilst also ensuring we can be able to fund that capital and that capital expenditure when it comes. And some of it will be coming in 2023 with a compression project, and then we expect further drilling from that point. So we try to get the balance right. And there's another question which relates to this, which is, would we consider a buyback program? Yes. We have initiated a buyback program. We initiated that in December last year. That is still ongoing. We announced that we would do up to £2 million, $2.6 million, and that will continue. And we will also look at the right balance and the right split between dividend and share buyback. But at the moment, we see that the two can sit quite nicely together as being both accretive and supportive by shareholders. So we certainly are, at these levels, given the value disconnect between our core value and our share price, we're very supportive of buying back our own shares to demonstrate our confidence in the level of the quality of the asset. Had one question here: why is the dividend paid out so late? We are a Jersey company, and so our final dividend is subject to shareholder approval at the AGM. So that really drives the payment of the dividend. The interim dividend is not subject, but the final is, and that's a Jersey company rule that we stick to. So we pay the dividend out as soon as we can after the AGM, which will be on the 22nd of June this year. Another question, will the Manasseh Bay partner drill additional wells in the coming years, or is that decision still dependent on a license extension? What signals regarding a license extension have the company received from the Tanzania authorities? Yeah, it's a great question. It's a discussion that's ongoing all of the time. We are committed to reinvesting, as is the operator, as are our partners, because we need to produce more gas. We need to get up to 130 million cubic feet per day, which is our contracted volume. We do need an additional 6 well in the field to do that. We produced over 110 million cubic feet per day last year from the 5 wells, but to reach up to the 130, we will most likely need an additional well. So there will be more drilling. Again, it's about getting the timing right, but now we can see all of this demand coming in a very real, tangible way. We are starting to think very much more detail about putting a work program, and it will come in hand with discussions around the commercial environment. So obviously, we need to be able to recover our costs of reinvestment, and obviously that relates to license extension. So those conversations are continually ongoing at this stage. I have another question here. Why did you recruit a chief operating officer, given the fact that WEN doesn't operate anything? Again, this really goes to our aspirations and our ambitions. I said earlier, we do have a great deal of influence in the JV. This isn't a very sort of light touch partnership as a non-operator from us. We're very involved. It's our only asset, and we take a very active role. It's important also to us to have a technical capability and to demonstrate firepower and horsepower for the growth. We're always looking at opportunities to add to the portfolio as well as extend what we're doing in Manasseh Bay. So we see growth coming for Wentworth in growing our existing asset and adding to our existing asset, and having more technical capability is something that we felt was important. We're a really lean, small team. There's very few of us, so it certainly helps give our ability to look at things in closer detail and run things in parallel with that extra resource. So that's really the rationale behind that, and to have ambitions to grow our business in an operated way if possible. Another question here: how will you be splitting free cash flow between increased dividends, buybacks, and M&A? Well, that's a great question. It really is our capital allocation policy, and you're absolutely right. It does need to be a balance between the dividend policy, which is a progressive policy, as we mentioned and committed to last year, and that's really fundamental to us. We don't want to do anything that compromises the dividend. We do need to also look at the level of buyback that we think, and is it more on the dividend, more on the buyback? That's, again, a conversation that is very much ongoing. So we will look at that. We need to retain financial flexibility in the event that something did go wrong. We don't obviously foresee that. And we also need to retain some balance sheet strength for opportunities. As we all know, coming from a place of strength allows us to take advantage of opportunities much more readily and easily. So it is a balance. It isn't, we don't set out publicly the split with free cash flow because it depends on the work program that we're looking for over the coming few years into the field. But it's very much a balancing act between those things. So thank you for the question. Another question here. More than good report. Again, nice to see a strong company and plenty of cash backing. It's like have $10 million, no mention of growth through capital expenditure or other use of this excess capital. When do you think you'll make your next update? Well, again, good question. Really hope that by the end of this year, we'll be able to talk more about a work program going forward. Again, we're working on with our partners on that. So until we've made a commitment and a decision exactly on what that looks like, we can't talk about it. But we very much hope by the end of this year that we'll be able to talk with more certainty and detail around what the future reinvestment looks like. And that will give a better idea of how we're balancing our cash for that use, but also for returning to shareholders. Question here: how much of the new demand from Kinyerezi 1 extension and new Bungo 3 will Mnazi Bay supply? And how many million cubic feet per day is Mnazi Bay able to supply at the moment? So great, yes, we are expecting incremental volumes, as I mentioned, particularly on this slide here. We don't really know the split. We won't have all of that incremental demand because Songa, the other operated producer, will also receive. But it doesn't really bother us too much because we think there's plenty of demand for both of us. We are also going to need to do more to supply. So as I said earlier, our current capability from the 5 wells in the field is around 110 million cubic feet per day. And then beyond that, we would need compression, an additional development well. So we are trying to time that in line so that when the additional demand is required, we're able to supply into that. And we will share that incremental demand with Songa. We share it now between the two of us. But again, that's good. It doesn't concern us. We will have more than enough demand for both of us going forward. Then it's not going to be a problem. Is there any serious consideration of investing into other assets across Tanzania or even beyond Tanzania to provide the company with diversification? Yes, absolutely, is the answer to that. We really do would like to have additional assets in our portfolio. We have to be very careful that we don't dilute the quality of Mnazi Bay with something that isn't good enough. But there are opportunities out there that we are looking at. Tanzania is a small opportunity set relative to some other African countries in the oil and gas space. But there are certainly things in Tanzania that are worth looking at. And again, for us, it's all about timing. It's all about getting the timing right when we see that increased demand coming through. And as you know, we're in production, but ultimately there'll be the right time for further exploration, for appraisal, for development. It's all about timing and balancing it with the growth in the economy and the growth of the demands. So yes, absolutely. Would we look at things outside of Tanzania? If it was compelling enough, yes. Ultimately, it comes down to the quality of the asset. That's really what it's about. The strength of the asset drives everything. So if there was a good enough asset where we could leverage our strengths, we would look at it. But fundamentally, we're really good at making Tanzania work, where lots of other companies haven't made it work so well. So we have to leverage and play to those strengths, because that's what we're good at. But if there was something that was interesting, we would also particularly in the domestic gas to power, because that really underpins our strategic focus. So it would need to have that in mind. Two last questions I have here. One is, can we expect some share purchases from management this year? Yes, I would like to see that. I think that is something that we can expect. When the opportunity is right. And as I say, at these levels of share price, I would certainly support that. And then the last question is, G&A costs went up close to record levels. Can we expect a reduction? We did have some increased G&A due to sort of additionally adding to our resource and our technical capability. We do look all the time at cost reduction, but we need to also ensure that this business is robust enough to give us the firepower to look to grow. And I wouldn't see those G&A costs increasing significantly as production, revenues, EBITDAX, profit, cash, all head in the right direction. So I think it's a solid, stable base and shouldn't move much from this point. So I hope that addresses that question. So Zach, that's all the questions I have from me.
Yeah. Thank you very much. I think you've addressed all those questions you can from investors today. And of course, guys, the company will review all questions submitted today and publish those responses on the Investment Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, please could I ask for a few closing comments?
Thank you. I just want to say thank you very much for those of you who have joined that are shareholders, for your continued support. I'm proud of our business, and I think we've got a lot of opportunity to take the business even further going forward. And for those who are new to the story, I hope you've enjoyed. I really appreciate you taking the time. I know how busy everyone is, and it's been a real pleasure to talk a little bit more about our strong results today. And if you get a chance to look at our sustainability report too, please do. So thank you, everybody, for joining and taking the time.
Catherine, thank you for updating investors today. Could I please ask investors not to close this session, as you now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few minutes to complete, but I'm sure will be greatly valued by the company. On behalf of the management team at Wentworth Resources PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.